Good morning, all of you. I welcome you all to the third unit of Financial and Management Accounting. And today, we will move into some practical aspects of accounting, and we'll try to learn that how things are actually being done and how we, initiate and we initiate the accounting process. So we'll start with the concept which is called as double entry accounting today, and we'll move to the general entries into the effect of these accounting transactions on the accounts. So to start with, if we talk about double entry accounting, right, we say that double entry accounting is the bookkeeping method. So if you guys remember, we discussed about difference between bookkeeping and accounting. So it is related to bookkeeping that keeps the company accounts balanced, showing a true financial picture of the company's finance. So we have the double entry accounting method, which actually shows the accounts balance and basically gives us the helps us in figuring out the true and clear picture of the company's finances. What we'll learn today, we'll try to learn the double entry bookkeeping, what it is, then classify different types of accounts in the traditional approach and the accounting equation approach. Then I will talk about the process involved in accounting trail, then the rules of double entry system of bookkeeping, and then we'll move to the journal entries in the journal. So how do we do that? I think next, when we talk about double entry system or double entry accounting, we say it is that every business transaction which is being done, which takes place, that has actually two impacts. In other words, we say it has dual impact. So when we say dual impact, that means that it affects two accounts. So any transaction which happens into a business, that is affects two accounts, because I'll can whatever I'll do, I'll buy, sell, purchase, uh, pay salary, pay wages, whatever I'll do, that will actually include accounts. And as the account will just move to the next slide, and we'll try to understand that the impact happens on the two different set of accounts or two different set of things. So when we talk about double entry accounting, we say that the features of double entry accounting is that every account has two sides. So we have whatever accounts we have, every account has two sides. So you must have heard about something called as debit and credit, right? And something called as, so some people have learned it as left side and right side. So that's a different way of learning it. But so we should understand that every account has two sides, and amount of benefits received by one account is equal to the amount of benefit given by the other account. See, we always say that when we talk about accounting, and when we discuss accounting entries, we say that it's like something which has been put, all everything is being put into the huge pot. So if something has gone inside the pot, something should move out. There has to be an outcome. There has to be a reaction of that. So every, it cannot be like one side impact, right? So that it's not like that everything can keep on going into the pot only. No, it has to move out, come out of that pot as well, right? So to start with, we start with the very basic part of it, and we call it accounting equation. And when we talk about accounting equation, we say accounting equation is actually equals to, we say that assets is equals to liabilities plus capital. Consider that you have all those assets which you have in business, right? How have you arranged them? How those assets have come? Either, I mean, of course, you have paid money for that, right? Now, how did that money come? That money entered into the business can enter into business through two modes only. Either it will enter through the capital route, where the owner or the investors or the people who are the, we can say, the shareholders or partners of that company will invest money, right? That is one route. Another way or another route which can we consider, or we consider one more route in addition to that, that is liabilities. I take a bank loan, right? I arrange money for my, you can say, business. I go to the creditor and I say, fine, you give me these goods and I'll pay you later on. So what I've done, I've kind of an arranged funding for my business. So I've got some assets which I should, which I was supposed to pay cash, but as I haven't paid that, so that's again a liability for me. So we say that every asset in a business, every asset which we have in business is an either it has come through the capital, which was the money which was being invested by the owners, or it has come up through liabilities. So that's something which we need to be very clear with. Now, I take you, we go to the practical example to understand this, and let's be very clear. And I would request you all to focus, give you a more than 100% focus on this, because today's class is something that if you will lose some concepts or miss it, your confidence building or confidence, shredding will start from today's class only. So please, I request you all to give more than 100% of your focus, and let's move to the practical part of this, how it actually works, right? So when you move to the accounting equation, right? Accounting equation is looks something like this: that assets is equals to liabilities plus capital. How does it work? It works like, let's say there is Mr. Abhi who starts his business with 1 lakh cash as capital into his business. So somebody is starting a business with a certain amount, right? So for business, I mean, if we look into it, there are two things which are getting impacted. What he's bringing in cash into the business. So what is coming in the business is cash, right? So I can say that I'm getting, and we all know that cash is an asset. We studied that, right? So I can say, fine, that cash is my asset, and I'm getting cash for my business. And how much cash is he bringing? He's bringing 1 lakh rupees of cash. So I have 1 lakh rupees, 100,000 rupees of cash out here. But the money which he is bringing, that money is also considered as a capital by the business. I hope you guys remember we discussed the concept of separate entities, right? So business and businessman are two separate entities. So any money which is invested in business by the businessman is considered a liability by the business. So if the capital, that's fine, but again, the capital is a liability, right? Because business assumes or business supposes that it will give the reward to the businessman for taking this risk with some additional profit in with that. So we say fine. So I have a cash over here, and on the this side we can say fine. This dark line over here, this divides these two sides. So asset should be equals to liabilities plus capital, and this line, this border actually divides these into two different segments. So we can say fine. Now I can write over here. Let's say fine. I wrote it capital. And how much is my capital? My capital is 1 lakh. So two accounts impacted. My cash got impacted because yes, cash entered into my business, and my capital got impacted because capital is a liability which has come up now because I have to business assumes that it has to be paid back. Now there's some furniture which is being bought. So a furniture being bought for the shop for rupees 10,000, right? So I bought a furniture for the shop for rupees 10,000. So what I do actually, I'll have so furniture. First of all, we need to clarify this. That what is furniture? Furniture is an asset or a liability, or it's an income or an expense, whatever. What it is. So furniture is coming. I'm buying furniture. So my business is getting a new furniture. Let's say your home gets a new furniture, right? So that furniture is what? Would it be an asset or a liability? Of course, anything which you buy, we have discussed that anything which you buy and we have a right upon, that is our asset. So now furniture, once you paid for it, you become the soulful owner of it, or your company or organization has a right upon it, right? So we have a new asset which comes up over here, that is furniture, right? And how much furniture do I bought? I bought furniture for 10,000. Right? So one account got impacted, that is furniture. Now, the question says that he purchased furniture to his shop for rupees 10,000. So I bought a furniture for my shop for rupees 10,000. So 10,000, the furniture I bought, but what went out of the business? So something like cash went out of the business. So if I have to, so cash moves out. So I have to reduce this cash over here, right? I can say by 10,000. So my furniture gets addition of 10,000, and my cash gets reduces by 10,000, right? Now we move further, and Now this particular equation, which was earlier into this frame, now will look something like this. So now I'm left with 90,000 of cash. I have 10,000 of furniture.
Prof,
And
Prof,
yes, sir.
sorry for interruption. One small request. If you can just on the right bottom, you can just make it as close to 150 or 200% so that the entries of Excel sheet will be more visible to the learners, Prof.
I'll do it.
Right bottom, you can just increase it
Yes,
little bit.
yes, yes. I
Yeah,
didn't
now it
pay.
will be better, Prof. Keep it manageable size so that it is you are also able to handle it.
I'll do it. I just missed it.
Thanks, Prof. Yeah. Now viewers will be able to see it very clearly. Thanks, Prof.
Is it okay now?
It's better, Prof. We can continue with this.
Fine. So now whatever cash I had, that cash got, because I paid 10,000 for the furniture. Now I'll see. Please recall, please keep in mind that we started business with 1 lakh rupees of cash. Now, as we have paid 10,000 rupees for furniture, so 10,000 moves out. So what I'm left with 90,000 of cash, 10,000 of furniture, and I have a capital of 1 lakh. So this is what I can say. I can say, this is my new equation, right? Or we can say the new equation after the impact 2. Now we have the third one, which says he buys goods for cash rupees 50,000. We all have studied that goods are actually those things or that stuff in which the businessman deals in. He does the business, right? So again, and if we have studied, that goods are, we call them stock, and stock is a part of our current assets, right? And so on the asset side, we can add one more thing over here, and we can say, fine, we have stock, right? So I bought a stock of rupees for cash rupees 50,000. So my stock, similarly as we did for furniture, please recall, please keep in mind, when we bought furniture, furniture increased, cash decreased. When we are going for stock, my stock will increase because my stock is coming, my business is gaining that stock. And what will decrease is my cash. So my 50,000 again my get added into my stock, and I reduce 50,000 from cash over here, right? So that gets reduced over here. So now again, if I move on to the new concept or new equation over here, my new equation would be 90 minus 50, that is 40,000. So no changes in furniture. Can I see any changes in furniture? No, no changes in furniture. So furniture remains 10,000 as the old one, and I have stock which comes up 50,000. You see, my both sides are still balanced, right? No, there is no deviation. I have 1 lakh on the debt on the asset side and 1 lakh on the liabilities plus capital side. So no changes have taken place. It's all equal. That's what this concept actually suggests. That whatever we do, right? Anytime your liabilities plus capital will be equal to your assets. Cannot go beyond that. Then we move to the next. So that he sold goods worth rupees 30,000 for rupees 40,000 on credit to Arjun. Now can understand this transaction. It's the goods worth rupees 30,000 being sold for rupees 40,000. So something which costed me 30,000, I'm selling that for 40,000. Am I making a profit or loss? Yes, of course, I'm making a profit. Profit of 10,000. So any profit or loss directly impacts my capital. So what I'll do is I'll add 10,000 into my capital for the profit. That's the first thing which I should do. Next, how much stock am I selling? I'm selling goods worth rupees 30,000. Goods were worth rupees 50,000 for me. Out of 50,000, I'm selling 30,000. So I reduce this 30,000 from here because 30,000 goes off, gets strikes off, right? Moves out of the business. What I'm left with, I'm still, you don't know, does that makes it balanced? Let's have a look at it. So I have 40,000, and I have 10,000 over here, and I have 20,000 over here. That's my stock I'm left with. So I have 40, 10, 50, 20, 70 over here, but I have 110 out here. So the total comes up 1,10,000. Right. Remember, please remember, whenever we sell, there's a debtor comes in. Whenever we sell on credit, there's a debtor. Don't forget. credit sale, debtor, credit purchase, creditor, right? So and we know that debtor is our current asset. So we go to the debtor over here and we write down how much do we need to take from debtor? The amount, total amount for which we have sold. So we have sold for 40,000. So the goods were worth rupees 30,000 for us, but as we have sold it for 40,000, so we have to take up 40,000 from that, right? So my debtor would be over here worth rupees 40,000. Does the equation balance? So we can just check it out, have a look at it. 40, 10, 50, and 60. That makes it 110. So 110,000 on the asset side, 110,000 on liabilities and capital side. We can say that things are going perfectly fine till now. We move next. We move next, and we talk about paid wages to servants, right? Or we can say paid wages to workers out here. So paid wages to workers for is 1,000. So once I have paid wages to my workers, right? So wages is what? It's when I pay wage, my cash goes out, right? My money goes out. So I'm paying 1,000. So 1,000 of my cash is going out. So I have to reduce this 1,000 from here, right? So this will become 39,000, right? And when I pay any expense, my capital also gets reduced, right? Because I've done an expense. So my 1,000 gets reduced from here as well, right? So I have 39,000 plus 10,000, 20,000 over here, 40,000 of the debtor, and I'm left with 1,09,000. So does it matches? Let's have a look at it. 40, 20, 60, and 70, and 39. That makes it 109,000. And over here we have 109,000. That's perfectly fine. So I hope you must have got some idea with this, right? So how does it work? This was very basic, right? I take you to another example, right? And it would be somewhat, more advanced than what we'd have done earlier. So let's say I have assets and I have liabilities and capital. So we should be thorough with it now that assets is equals to liabilities plus capital. Now again, I hope you should please do it together if you can, all of you. So we have the owners invested 25,000 in cash to start the business. So owner is investing 25,000 in cash to start a business. We did it. We have done it in the last that whenever owner invest in business, we say it's a cash over here. So I have a cash of 25,000, right? And on this side, it will be a capital. So the capital is being invested, that is 25,000. The month's rent of 5,000 was prepaid in cash. So the rent was prepaid in cash. So I have paid a rent as a prepaid in cash. So remember, whenever we pay and whenever we do any expense, our capital decreases. So the impact of this would be that I'll have minus 500 from here as rent, and I'll have prepaid expenses. We know they are our assets, right? So I'll write down over here prepaid expenses. And I hope you guys can recall which category it is, right? Prepaid expenses. It's a fixed asset or a current asset, right? So we should be able to figure it out that it's actually a current asset. Right? So in my prepaid expenses, my 500 gets added, and from my cash, my 500 gets reduced. Right? So if I talk about my new equation out here, I'll have 24,500 in cash, 500 with prepaid expenses, and I have 24,500 in capital. Sorry. That's perfectly. I mean, it has to be 25,000 on the capital only. So I'll have prepaid expenses of 500 and a cash of 500 because I paid a cash and I got a prepaid expense. So it is still as an asset with me. So I'll not deduct it from the capital. Then we go to the equipment costing 8,000 was bought on credit. Remember, we bought on credit. The moment we bought on credit, there is a creditor, and creditor is our liability. So we have somebody over here as creditor, and he will be our liability. So how much equipment? What was the cost of equipment? That was 8,000. My capital remains 25,000 because nothing has moved out of the business. My cash remains 24,500 because cash has not been impacted in this transaction. My prepaid expenses still remains 500, and I have a new head over here, which I write as equipment. So I have an equipment, and how much is that worth of? That is worth of 8,000. Right. So if we look onto what is the new equation, what new equation do we have? So we have a new equation as so we can say this is my new equation.
Sir, out thoda zoom karo sir. Thoda zoom karo. As we keep moving, thoda keep it zoom. Maybe little bit more, another 10-20%. Better now. Yeah. This is better. Yeah.
Right. So any impact on the cash? No, zero impact on the cash. Any impact of prepaid expenses? No, zero impact on prepaid expenses. But yes, equipment increased by 8,000, and we have this. Now the next part comes, that we paid 500 for office supplies. So 500 being paid for office supplies. We can say it is stationery as well, right? So you bought some stationery items for rupees 500, or any other office supplies as well. So 500 moved out of the business, right? So I have to reduce 500 from here, from my cash. And when I go to I have to create one more asset over here, which will be called as office supplies. And that office supplies there's an addition of how much? 500. Right. So when I again move to the new equation, that comes up as 24,000 over here. There's zero impact on prepaid expenses, so that will remain 500. Right, there's zero impact on equipment, so it will remain 8,000. And I have my office supplies, which will be increased by 500. Any change on the capital? No change on the capital because I bought office supplies. So I paid cash. Cash moved out of the business. That's why I reduced my cash over here. And I got office supplies. So my office supplies increased. So I added office supplies over here. Any change in capital? No. No changes in capital. So capital remains at 25,000. Any changes on creditor? No changes on creditor. Again, zero impact on creditor. So my creditor remains 8,000. Right. I hope it's still balanced. Yes, 24 and 8, 32 and 1. That is side of 3. Perfectly fine with us. Now we paid 750 first paid in cash. So 750 paid in cash. So for advertisement. And that's it. This is an expense. Do we get any asset when we pay for advertisements? No, we don't get any asset. But it's an expense. So when it's an expense and we are saying that we paid it in cash, so the first impact goes on my cash. That my cash gets reduced by 750. What I'm left with is 23,250. And whenever we do any expense, it goes out of my capital. So again, my capital gets reduced by 750 over here. And I'm left with, over here, I'm left with 24,250. Any impact on prepaid expenses? No, zero. Any impact on equipment? Zero. Any impact on office supplies? Zero. Creditors? Zero. So I am left with, my new equation comes up something like this, that it is 23,250 of cash, 500 of prepaid expenses, 8,000 of equipment, and 500 of office supplies. On the creditors and liabilities and capital side, I have 24,250 as capital and 8,000 as my creditors. We move next, and it's again something which is very similar to the last one. Earlier in the last one, we paid advertising expenses. So we deducted 3,000 from we deducted that amount 750 from cash, and we deducted 750 from the capital. Now similarly, the name has changed, but the nature is same. If you see, we are paying in the point 6, we are paying salary. It's row 13.6. We are paying salaries. And how much salary are we paying? We are paying a salary of 3,000, right? So it's like any other expense. We'll do the same treatment with this. What we will do, we'll deduct 3,000 from the cash for salaries, and we'll deduct 3,000 from capital for salaries. Any impact of prepaid expenses? No, zero. Any impact on equipment? Zero. Any impact on office supplies? Zero. Any impact on creditors? Zero. So my new equation, right? That comes up something where I have can say it is 2125. I mean it's 20250, 500 for prepaid expenses, 8,000 for equipment, and 500 for office supplies. Similarly, 21250 for capital and 8,000 for creditors. We move next, and when we talk about next one, where we earned a commission of $10,000, of which 2,000 was received in cash. So we have earned a commission of $10,000, of which 2,000 has been received in cash. So we have still need to receive 8,000, right? And 2,000 has been received in cash. So fine. So what we can do, as we have received cash, so my cash increases by 2,000. My prepaid expenses has no impact. My equipment has no impact. Office supplies have again doesn't get impacted by this. But I'm still to receive 8,000, right? So I can say that 8,000 is my debtors out here, and I can write it down that 8,000 as a part of my receivables. Do I have anything added to the capital? Yes. So I have earned 10,000, whole 10,000 as a commission. So that can be added into the capital. That's my earning, and I'm left with no impact on credit. So if you see, I mean, if we go into it, you will realize that every transaction, whatever we are doing, those transactions are having an impact on two accounts, on the two sides, either onto the asset side or onto the liability side, or if you see some transactions like this, we are having an impact onto the maybe both onto the asset side. Both impacts are only on the asset side, but they are impacting two accounts. Two accounts or more than two accounts are getting impacted by any transaction. So that's why we call it dual aspect. Now, similarly, if we take it on further, we paid 5,000 of the 8,000 owed to the equipment supplier. So we paid 5,000 which we owed to him, right? So if you again we look onto the new equation, what we have, the new equation would be something like 2225. 22250. No impact on prepaid expenses 500. No impact on equipment 8,000. No impact on office supplies, that was 500. And debtors again, it is 8,000. And over here it would be 35,000 and 8,000. Then we paid 5,000. 5,000 we paid to whom? We paid 5,000 to the person who supplied us that equipment. So where he was, see, we have to pay money to someone. So if we have to pay money to someone, he would be a liability for sure, and we would have classified him as a creditor. So from this 8,000, remember this 8,000, we bought an equipment for 8,000, and so we had an equipment of 8,000 and we had a creditor of 8,000. So when we bought this 8,000, out of this 8,000, we paid 5,000. So again, my cash will get reduced by 5,000. Will it impact my prepaid expenses? No. Will it impact my equipment? No. Will it impact my office supplies? No. My debtors? No. Right? Will it impact my credit capital? No, it will not impact my capital. Will it impact my creditor? Yes, it will impact. It should, because I have to pay him 8,000 as such, and out of total 8,000, I have paid him 5,000. So it will get reduced by 5,000. Right? So I'm left with now 17,250 of cash, 500 of prepaid expenses, 8,000 of equipment, 500 of office supplies, and 8,000 of debtors. Again, I have 35,000 of capital with me, and I have 3,000 of creditors. We move next. Used, worth 100 of the office supplies. So consume the worth 100 of the office supplies, right? So office supplies being used for the, we can say for the personal use, or maybe, it has been consumed. So what we'll do is we'll write over here, uh, will it impact, let's do it like this, will it impact my cash? No, it is not impacting my cash. Is it impacting my prepaid expenses? No, it's not impacting my prepaid expenses. Equipments? No. Office supplies? Yes, it is. And how much? So 100 have moved out. So we have used 100 of it. So how much does it impact my debtors? No, it is not impacting my debtors. Now, as I have used it, it has been consumed, I am supposed to reduce 100 from my capital as well. So any expenses and losses, reduce it from the capital. Similarly, any incomes and gains, we add it to the capital. So creditors, no impact on creditors. So I'm left with again, I can say we are left with this over here. $400 out here, 8,000, 34,900, and 3,000. And we move to the last part of this example where we say that paid 100 for wages. So yes, paid 100 for wages, and again, paid 1,000 for wages. So again, it's an expense. So we'll reduce 1,000 from our cash, and we'll reduce 1,000 from our capital. Does it impact any of our rest of the accounts? No, it doesn't impact them. And I end up this with the balance of 16,250 on for cash, 500 for prepaid expenses, 8,000 for equipment, 400 for office supplies, and 8,000 for debtors. Similarly, over here, I have 33,900 as my capital. It has to be 1,000, sorry. And I have 3,000 as my creditors. That's where I end this particular, we can say, the question. So, is the balance equal? Let's have a check at it. We can have a look at it. It's 33900, and this is 33150. I've done some changes into this question, so that's why the balance would not be matching right now. But I just wanted to make you understand that this particular how it impacts the two transactions, and how this actually we can figure out that what is increasing and what is decreasing. That needs to be taken care of. Fine.
Prof, if you
Yes,
can, once you do this, if you can just summarize this and also share that Excel sheet with me, because many learners want to have this, I can mail it to them with the entries.
Not a problem, sir. I'll do it.
Yeah. Just summarize it, and then finally, when you move out of this, you can share the Excel sheet later with me. Thanks, Prof.
Sure, I'll do. So if you have a look at it, the basic idea of doing this exercise with you guys was to make you understand that how everything impacts the rest of the two things, right? So when we started with first one, we had the cash. Business started with cash, so we had a capital which increased by a certain amount, and the cash increased with certain amount, right? And again, so if you look, when we go for the prepaid, when we paid rent as a prepaid, so we had a prepaid expenses as an asset, or we can write it prepaid rent as well. That's not a problem. So it depends how do you want to classify it. So I can write it prepaid rent, and I have 500 as moving out from my cash. So this is how this is how the transactions impact. So just to have you an idea how things work, we came up with this I came up with this example of doing it. I'll share this Excel sheet later on with all of you. Not a problem in that case. I'll share it with the sir, then he'll share it with you guys. So we move back to our PPT, and let's see what more do we have over here to learn. If we move to the next, the part of the PPT, this is how what we did. This was our first example. And how does it look like in a balance sheet? Right? So that's something which everybody should have a question. That's fine. This was an accounting equation, but how would it look like in a balance sheet? So if you go into this, I'll shift to sheet one over here, example one, and I'll take you with that, right? So when we said that the person has started business with cash, right? So it looks like something like this in a balance sheet, that you have a liability on the one side and the asset on the other side. So you have a capital and the cash, right? That's how the balance sheet looks like. We move next, and when we talk about that purchase furniture, so if you see, this is how your balance sheet moves further. Your cash gets decreased by 90,000, your furniture gets added by 10,000, right? And your capital still remains the same. We move next. He buys goods for cash rupees 50,000. See, goods bought for rupees 50,000. So 50,000 got reduced from cash. That's what we did. Stock of goods increased by 50,000. We did exactly same. 100% what is being shown over here. No deviations from it. But these are two ways of showing the same thing. But yes, if you'll ask me, that is accounting equation. This is balance sheet. But if you see again on the one side, I have all my assets. On the other side, I have all my liabilities in capital. We move on to the next part where we say that goods worth rupees 30,000 were sold. So if you see, this is how it looks like it would be now. So cash 40,000, furniture 10. Arjun, we sold it in for 40,000. So 40,000 needs to be taken from him. That's why he's over here as debtor. And then we have added profit of 10,000. And we move to the last part where we say he paid wages to workers. So if you see, payment of wages to workers 1,000. So we reduce from capital and we actually reduce from cash. It could have been can be from the capital as well. So that's why the total impact has been shown over here. So that's why it's deducted from 10,000. Otherwise, it could have been from the capital as well. So overall, if you see the both sides tally, they both are equal. 1,09,000, 1,09,000. Now this is where you are supposed to be 100% clear. Otherwise, the next concept or next classes would be you will be feeling like you're out of the we can say the class or out of the normal understanding, right? We move next. Now we talk about accounting classifications. How accounts are being classified. Now accounts are being classified in two approaches. One approach was considered as traditional approach, which actually focused and which has divided the total accounts into three parts. The another approach, which we know as modern approach, that divided the accounts into five different categories. Let's have a look at it. The traditional approach suggested that the accounts can be divided, all accounts, whatever accounts you have. You have your building account, furniture account, salary account, rent account, cash account, bank account, whatever accounts you have, the n number of accounts which a business has, that can be divided into these three categories. What are these three categories? The first one is personal account, second one is real account, and the third one is nominal account. So I say that if you give me the bunch of accounts, whatever accounts they are would be, I can divide those accounts into three categories. That would be personal, real, and nominal. Now moving further, when we talk about the traditional approach, so what comes under personal accounts? Please try to understand in this way that personal accounts are those accounts which either denotes a person, which is either with the name of a person or denotes a person, right? Or an entity or an organization. That is personal accounts. Anyhow, that can be considered as a different entity or a different person, or I can say as a different organization. That is personal accounts. Please don't get confused over here and try to pay attention to this. So when we say personal accounts, it's like all persons, like individuals, firms, and associations. So See, there's a creditor account. So creditor is someone from whom you would have bought. Now it could be an organization, it can be an individual. Similarly, we can have a debtor account. So debtor is whom you have sold. So it could be again you would have sold to a person or you would have sold to the any large size or mid size organization. Bank account. Bank accounts, though but bank accounts are being opened by the organizations. They are opened by the individuals. That's why bank account falls under this category. That is personal account. And then we have prepaid expenses account. You should be wondering, in fact, all of us can wonder that why prepaid expenses account is here, because prepaid expense is something which is an expense. And again, there will be a nominal account which will ask you that find all expenses and losses they get into this category. But prepaid expenses, they denote an organization to whom we have given it. It actually denotes an entity. It denotes a particular person. It denotes a particular, we can say unit where we have whom we have paid it. That's why this prepaid expenses account comes into the personal. And then after this, similarly, we can have outstanding expenses account. Outstanding expenses is what? The amount which we were supposed to pay but we have not paid. That's maybe your salary, that may be your wages, that may be your rent. Now, any amount which you were supposed to pay and you're not paid it, that falls into the category of outstanding expenses. True. But again, that is due to somebody, that you owe to someone, that you need to pay to him. Again, because there is an organization, there's an entity, there's a person behind it, it again falls into the category of personal account. The list is not complete. I'll not say that the list is complete. There are examples which I have taken over here. Right? Moving further, from personal accounts, we talked about the real, again, sorry. So, getting into more details into these personal accounts. So, if you talk about personal accounts, then can be categorized into three categories, right? So, we can have an account of persons, right? So, as you saw, we had debtors account, creditors account, and I told you that they can be with the name of persons, organizations, entities. So, we have an account of person. You can have a John account, Robert account, X account, Y account, Z account, any account you can have like that. The artificial persons account, so the bank accounts, what we have with several individuals or organizations, they have that can be considered as a part of personal account because they represent the organization and institutions. And then representative personal accounts, outstanding rent account, prepaid rent account, they all fall into the category of representative personal account. They represent. Next, we go further, and when we talk about real accounts, so real accounts are all those accounts which are related to assets. Now, your assets can be we have discussed about tangible and intangible assets. Tangible assets are those assets which can be touched and seen and have a physical existence. So your building, your furniture, your cash, they all are called tangible assets. And when we talk about intangible assets, you have your goodwill, which forms a part of your intangible assets. And they are copyrights, trademarks, patents, all those, they fall into that category. So all those assets, whether tangible or intangible, that fall into the category of real accounts. Moving further, we talk about nominal accounts. And what are nominal accounts? Nominal accounts are accounts which are pertaining to all income, expenses, losses, and gains. So all that income you are earning, all expenses you are incurring, losses you are bearing, and the gains what you are having, that all falls into the category of nominal. So income, expenses, losses, and gains, they fall into the category of nominal. And when we talk about nominal, we'll later on clarify, we will learn that nominal accounts are those accounts which are not being carried forward. They close in the same year. So we close all these accounts into the same year. That's what the nominal account is. So that was traditional approach. Now modern approach try to make it we can say they try to make it more convenient or try to make it more simple, and they classified the total accounts into 5 categories. So they said fine. The first one is revenue, second one is expenses, assets, liabilities, and capital. So they said no, you don't need personal, real, nominal, not required. I mean that's something which is a lot for the for people to have an understanding and to learn and to understand. They said no, fine, let's make it simple. Divide it into four parts. So all the and you if you will see anybody who is being in touch with accounting or has would have studied accounting in the past or working in accounting, you will realize that all accounts can be categorized into these categories. Either you will have a revenue, or you will have an expense, or asset, or liability. We'll move to the transactions later on, where I'll help you understand that how this can be done. So if we club all these, because liabilities and capital get into one category of account, that is liabilities, we club into one word and we can say real, that is REAL, real. And this is one word which has the whole accounting in it. The whole accounting lies in this. To brief, revenue, expenses, assets, and liabilities. That's the modern approach. Now, when we go to the accounting trail, all right, how does accounting trail works, or what is actually accounting trail? So we can say accounting trail is the sequence of transactions, how these transactions work, and finally they result into the financial statement. So when we talk about accounting trail, the first thing which comes up is that we identify the transactions and events. So what all transactions are there, what all events are there, they are being identified. Then we prepare vouchers. So either vouchers are already there, or if not, we prepare them, and then those vouchers work as a support or as an evidence of that transaction. Then we record those transactions as journal entries that we'll learn today. Then preparation of ledger accounts. So after the journal entries, we move it to the ledger accounts. Then the next step is you close these ledger accounts, or you balance. We call that the closing is called as balancing as well. So we balance these ledger accounts at the end of the period. Then whatever adjustments were left, or something comes up, it creeps up later on, or it was not there earlier, that is being included and incorporated. I take it further. Then we create a trial balance, and then when we create a trial balance is a kind of a document, or we can say the statement which shows us the balance of all the accounts on a particular date. And finally, we prepare the financial statements and the balance sheet with the help of all these efforts what we have done. We move next, and when we talk about next, we talk about transactions and events. Generally, the transactions and events are differentiated on the basis of we can say that a transaction is something which can be only of money or money is worth. So it may be cash transaction or a credit transaction. So I said fine, I'll go with the cash transaction. So when I'm buying in cash, I'm selling in cash, that is called as cash transaction. But when I'm not buying on cash, I'm not selling in cash, that is called as credit transaction. And when I move next, I talk about events. So event says that which are neither cash transactions nor credit transactions, but they have an impact. So there is no financial involvement, no money is involved, but yes, no inflow and outflow of money is involved, we can say. But yes, they have an impact. So if you talk about depreciation, right? Depreciation is one of the examples. We make provisions. Provisions are another example of that. So these events, they take place, but again, they have no inflow and outflow of money caused by these. Then we move to the rules of double entry system of bookkeeping. So what are the rules? So if we talk about rules, we have the types of accounts, that is personal. So again, as I've told you, all the accounts are being divided in two categories. We call it debit and credit. We'll learn it when we'll go for the ledger posting, like what is debit and what is credit. Then personal account is received as with debit the receiver, credit the giver. That is the rule for personal account. Real accounts, it is what comes in and what goes out. So debit what comes in, credit what goes out. That is for the real accounts. Nominal accounts, debit all expenses and losses and credit all income and gains. So people actually, do a different approach as well. So they learn journal entries, but that comes very far off. They learn journal entries, and once they have journal entries in their mind, they easily classify, which accounts falls into which category. But for us, it's better that we follow any of these approaches, that is traditional approach or modern approach, and then we decide that fine, what approach do you feel like it's convenient to understand, and then you can move ahead with that. Then the rules and for the modern, you can say accounts, or the modern, you can say approach. That's then again, it's a simple one. It says, so whatever assets, right, and whatever whatever revenues and assets you have. So if you have an asset, right, debit the increase, credit the decrease, right? So all assets and expenses, that falls into one category. So I have all my assets and expenses that falls into one category, and I say whenever it will increase, I'll debit it, and whenever it will decrease, I'll credit it. All my revenues and liabilities, they fall into another category. So if my revenues and liabilities, if they will increase, I'll do the opposite. I'll credit them, and if they will decrease, I will debit them. That's how this table suggests us actually. If you see asset account, debit the increase, credit the decrease. Expenses account, debit the increase, credit the decrease. So they both fall into one category. Assets and expenses go alike. Then you have liabilities in capital and revenue. So credit the increase and debit the decrease. So they go opposite. That's how it works. With practice, you will get a hands on it, that what actually moves like what. Then we again go back to our Excel sheet to have a view of it. So I have two questions with me today. Again, it's an example only, and I have taken it from your book to make it convenient to you guys, so that we'll do a part of it, and the rest you can do at your own, at your home. And whatever problems you can have, we can either discuss in the discussion forum, or you can ask the questions maybe in the next class whenever you feel like. So when we talk about when we move to the question, right? So this is how we say, we do it in traditional way, and we'll try to understand these concepts in traditional way. Then the application part, or the amounts, how to fill that we'll understand later on, not a problem, right? If you talk about the first transaction, right, it says that Subramanya started his business with cash of 5,000 or 5 lakh. Somebody started a business with cash. I hope you guys can recall that when business starts with cash, so the two things increases. Either the cash increases and the cash increases and the capital increases. So two accounts are involved. I should be very clear with this, and that is, one is cash account and another one is capital account. Right. So I have two types of accounts involved in this. That is a cash account and capital account. And if we look onto the cash account, right? So what kind of an account is cash account? So we discussed, that all accounts which actually relate to an asset, they get into the category of real accounts, right? Personal, real, nominal. Please remember, right? And then capital account, because it denotes a person, it falls into the category of personal account, right? So when I say the impact, what is the impact of this? So the impact of the first, what is happening is cash is coming in, right? Yes. So cash account, yes, it's real, cash is coming in. And on the other side, I'll take you to the rules. So my real account says that debit what comes in, credit what goes out, right? So cash account, real. My rule says debit what comes in, credit what goes out. So fine, cash is coming in, so I have to debit it. I write debit. Capital account is again personal. And what is the rule of personal account? Personal account says debit the receiver, credit the giver. Right? So who is giving me? The personal, the owner is giving me, and that is called as capital. So that's why I credited the giver. Remember the rule: debit the receiver, credit the giver. So cash being debited, capital being credited. We move next, and it will get you'll get more clarity as we proceed further with the number of transactions and number of examples, right? So borrowed from Mahesh. So borrowed from Mahesh, again, cash comes in. So we have seen that cash is a real account. We have understood that. And the real account says debit what comes in, credit what goes out. This is the rule for real account, right? Debit what comes in, credit what goes out. So is cash coming in or moving out? Cash is coming in. If cash is coming in, I'm supposed to debit it or write it on the debit side. So I say cash account debit. What I'm getting, I'm taking a loan from Mahesh. So no issues, I'm taking a loan, but that loan is actually representing Mahesh, right? So my loan from Mahesh is again my personal account. And the rule of personal account says debit the receiver, credit the giver, right? So I debit the receiver and credit the giver. So Mahesh, because he is giving me, I credit him because he's the giver, and it goes for the credit. So let's say we purchase furniture, and purchase furniture worth rupees 100,000 for cash. Two things are happening. Furniture is coming in the business, cash is moving out of the business. This in and out we have to be very clear with. So furniture is coming in the business, cash is going out of the business. So let's see what kind of account a furniture is. Furniture, we said all assets accounts are real accounts. So two accounts are involved, furniture and cash. And which category do they fall in? They both are real because the definition of real account says that all assets falls into the category of real accounts. Perfect. So debit, the rule says debit what comes in, credit what goes out. What is coming in? Furniture is coming in. So as furniture is coming in, I am supposed to follow my rule. And the rule says debit what comes in. So my furniture gets debited. Have a look over here, please. My furniture, it's a real account. Furniture is coming in, it gets debit. What is going out? Cash. Cash is going out. If cash is going out, that is again a real account. And I'm paying. The cash moves out. The rule says debit what comes in, credit what goes out. A real account. I am supposed to follow my rules only. So I'll credit the cash. So the transaction would be something like furniture account, which will be debited. The cash account will be credited. Similarly, we move next, and when we talk about purchase furniture from Mohan on credit. So we purchase furniture from Mohan on credit. Now understand, right? So purchase furniture from Mohan on credit. So we purchase furniture from Mohan on credit. What comes into the business? Analyze this. Have a view. Furniture is coming into the business. What is moving out? Is something moving out? No, nothing is moving out. So something has to be there, right? Because I'm buying an asset. So if no cash is moving out, there has to be liability. What liability is there? I'm buying from Mohan on credit. If I'm buying from Mohan on credit, Mohan becomes my creditor. And when he becomes my creditor denotes a personal account because my creditor is Mohan. Mohan is the person. This is nothing a person. So so there are two accounts involved. One is furniture, another one is Mohan. Furniture, real account. The rule says debit what comes in, credit what goes out. Furniture coming into the business, getting added. I'll add it into the. It will be on. I'll debit it. Now in personal account, the rule says debit the receiver, credit the giver. So are we? I mean, who is giving us? Mohan is giving us. So we will credit Mohan and we'll say that Mohan is the giver. So that's why Mohan is being credited. I'll To the next example where, yes, we can have. So now we have the next example where the goods are being purchased for cash. So I purchase goods for cash. So I'm purchasing, and purchases, we said purchase is an expense for the business, and all expenses fall into the category of nominal account. So the nominal says debit all expenses and losses. So I have a purchase account, which is an expense. I need to debit it. So I debited and I have purchased it for cash. So cash is moving out. The another account which is involved into this transaction. And cash says, the rule says, cash is, first of all, we should be very clear. Cash is what account? Cash is real account. And if cash is real account, the rule for real account says debit what comes in, credit what goes out. So what is going out is cash. And if cash is going out, I'm supposed to credit it. So I write it purchases account debit to cash. This is, I again remind you, this is the, I've taken this example from your book only. So please, basically there are 26 transactions. So, I have taken few for your understanding. I would, I can go through all of them, not a problem, but I would like you to go through the rest of the transactions. Please note down your problems. Whatever difficulties you find, you can have it, and then we can discuss it later on. And you have to do it the way I have told you. First, figure out what account it is. Next, figure out what rule applies. And next, you decide that what is to be debited, what needs to be credited. So I'll take you to the modern approach quickly so that we can have an understanding of both of them. That is your traditional approach and your modern approach. Same transactions, we'll do it with modern approach now. So the modern approach, that's how it looks like. Uh, Subramaniam started business with cash, so Subramaniam started business with cash, so then own 5 lakhs. The same transaction which we did. Remember what we did here? We classified accounts into real personal. Cash is coming in, going on, debit credit. That's what we did. Over here, oh sorry, in this particular transaction or in this particular page, if you have a look, the accounts will remain same because you cannot change them, right? The accounts will remain same. You will have a cash coming in, you have a capital being raised. So, but in spite of classifying them into real personal nominal, we'll differentiate them. Is it an asset or is it a liability? For your convenience, please consider capital as a liability. Always, always. Because the nature is all same. It falls into that category only. So we have cash is an asset and capital we can say, it's a capital or we can say it's a liability. What is increasing? When cash is coming into the business, so cash is coming into the business. So cash is increasing. It's going up, up. And on the other side, capital is also increasing because somebody is investing money into my business. Now cash is also increasing, capital is also increasing. But cash is my asset. And I've learned that if my asset increases, I'm supposed to debit it. So my cash asset increases, I debit. Capital. Capital goes like liability. If capital increases, it has to be credited. So capital increase credited. Similarly, I borrowed from Mahesh. Next transaction. So borrowed from Mahesh. What did we borrow? We borrowed cash, right? So cash again. Cash is my asset or liability? Cash is my asset. Is it increasing or decreasing? Increasing. I'm borrowing. If you borrow, your cash increases. You take a home loan, you take a personal loan, you borrow from your friend, from your colleague, your cash increases. So when I borrow from Mahesh, my cash is increasing. And cash, if it increases, I know I'm supposed to debit it, so I debit it. Similarly, loan from Mahesh is a liability. Loan from Mahesh is a liability. And if a liability increases, I'm supposed to credit it. Right? Cash, asset increases, debit. Loan from Mahesh, liability, increasing credit, right? Because we need to repay. Although yes, we agree the cash is increasing, but the loan is also increasing. Similarly, in the first transaction, cash was increasing, but the capital was also increasing. Right? We purchased furniture. Purchase furniture for cash. So furniture and cash, they both are assets, right? We should be with every class or with every more learning we are having. We should get very clear with this. Furniture and assets, they both are cash. They both are assets. Sorry. Furniture. I'm buying furniture. Furniture is increasing. What is decreasing? Cash is decreasing because I'm buying a furniture for cash. Furniture, my asset decreases. I'm supposed to credit it. Sorry, increases. Furniture, my apologies. Furniture, my asset increases. I'm supposed to debit it because I'm buying it. Cash, because I'm paying, it is decreasing. It is decreasing. My modern accounting rule says cash decreasing. Please credit it. Don't panic. Don't think. Give it a second thought. Right. Next, we purchase from furniture from Mohan on credit. Again, two things involved: furniture and Mohan creditor. Furniture asset increasing debit. Mohan liability creditor increasing credit because Mohan we have to repay him. Though we have bought a furniture, but we need to repay him. Right. Similarly, we purchase goods for cash. Purchase goods for cash. Purchases expense. And when we purchase, my expense increases. When you buy more, you pay more. And when you pay more, your expense increases. Purchase expenses increasing debt. This four things should be very clear in your mind. What it is, what nature it is, what is the effect, debit or credit. Then I'm purchasing for cash. Cash is getting impacted. It's an asset. Increasing or decreasing? Because I'm paying, it is decreasing. And if it is decreasing, I need to credit. Similarly, purchase goods from RAM on credit. Purchase expense. Increasing or decreasing because I'm purchasing, increasing. Debit or credit? Debit. Cash, I'm buying from Ram on credit. So Ram, he would be my creditor. Creditor is a liability. When I buy on credit, my liability increases. And if my liability increases, that is credit. Similarly, we go with the last two now to understand it more, and then I'll request you all to please go with it. We'll go with all this again. In your, it's there in your book, so you can try to do all this, in your book when it is there. Then we move next. We say sold goods for cash. So we sold goods for cash. So cash, asset, and when I'm selling, does my cash increases or decreases when I sell? When I sell on cash, you had your mobile, all of you in your hand. If you sell your mobile right now for any amount, will your cash increase or decrease? The cash will increase. Right? So my cash asset increases. I know I need to debit it or credit it. I need to debit it because my asset is increasing. The modern accounting rule says revenues and liabilities if increase, please credit. Assets and expenses if increase, please debit. Then I bought the goods for cash, so it's a sale. It's a sale. So sale is a revenue. So if I'm doing sale, my sale is increasing. If it increases, it's again credit. Similarly, we move to the last transaction of the day. So sold goods to Sham on credit. So I sold goods to Sham on credit. Goods sold to Sham on credit. Now Sham would be my debtor or creditor. Remember sales. Whenever we sell, we have a debtor. right? Do remember it with your credit card, right? So whenever you buy it on credit, there's a creditor, but whenever you sell it on credit, there's a debtor. So debtor is your asset or liability? Debtor is your asset. And does that asset increases or decreases when you sell? The asset increases. And if my asset increases, by this time I'm clear that if my asset increases, I'm supposed to debit it. And I debit. Similarly, I'm selling. And sales is again my revenue. And if my revenue increases, I know that revenues and liabilities, if increased, please credit them. So I say find sales, revenue, I'll increases, I'll credit. With this, um, we come to the summary that what we have learned today. We will move to the ledger posting in the next class because it was you guys are supposed to be very clear with these initial concepts when we start. Otherwise, later on it will be a bigger problem for you. So we'll go to the ledger posting in next class, though it is related to the same unit, but no issues. So we go to the what we have learned today. If we go to the if we go to the summarizing it, we learned concept of double entry accounting. We learned the different classification of accounts, and we learned the rules related to accounting and impact on the accounts. Please remember, you are supposed to do these two examples from your book only, and try to figure out either two approaches, a modern approach or a traditional approach. Clearly have a picture in your mind that which one will you follow. If you are following traditional, go to the personal, real and nominal. Follow the rules, debit the receiver, credit the giver, debit what comes in, credit what goes out, debit all expenses and losses, credit all income and gains. If you go to the modern, please classify the accounts into four categories or maybe five, but you can do it in four. Revenues, expenses, assets and liabilities. And when we say liabilities, we assume that capital is included into that. Decide what is increasing, what is decreasing, what accounts are getting impact, and what is, what needs to be debited, what needs to be credited. Please try, put in your time, give you some time to this and learn it. These are actually very important for your knowledge and for your learning part of things. Now, we can go ahead with the question answer session. Sir, if we can open it now for the question answer session, please.
Prof, thank you for this new experiment of the easy way to teach. Most of them have understood, but few still have their doubts. So the number one request on behalf of the learners is that Excel sheet is must kind of thing, so that they can try out practice at their end the way you guided them with the help of the entries given in the book. So please share that with me. I will share that with all the learners today itself so that they will be benefited, Prof. So that's the first request. Now I will get into some of the doubts, important doubts, questions asked by the learners. The first one, when we sell goods worth of say 30k and earn 40k, the profit is 10k. So why we are adding 40k as debtor and not cash?
Great, good. We because sold it on credit. It was sold on credit, so that's why we added it into debtors. Had it been sold for cash, right? 40,000 I would have received immediately. Then that 40,000 would have been added into cash. But because it was not a cash sale, it was a credit sale. That's why that 40,000 got added into the debtors. Second thing, we add the amount for which we have sold, irrespective of the profit or loss. The same 30,000 worth of goods could have been sold for 25,000 as well, 20,000 as well. So you will only add the amount which we are supposed to receive from our debtor. Right? It can be any amount. So because this transaction had a profit, that's why because we have to take 40,000 from the debtor, we added 40,000 in the debtor.
Okay.
No, I'm done, sir. Please, we can move to the next question.
Yeah. What is the utility of accounting equation in present accounting system?
The utility of accounting equation is, we can say that the biggest statement, what we say, the most important statement of accounting, that is balance sheet, that is based on that accounting equation only. The concept is same. So it's like we don't make accounting equation in real practice. Yes, it doesn't happen. We make a balance sheet, but we should be very clear with the conceptual knowledge of it, that how things are working out. So when it comes to the students for learning accounting and for telling them that how things proceed, as a the student, you should be very clear that all assets are equal to liabilities plus capital. And yes, we don't prepare accounting equation in daily in business, but for the understanding, it is required.
Right. We discussed about office supplies as an expense, then why this comes under assets?
Uh, See, it came under assets because office supplies is something which will not consumed in one go, right? Furniture is also an asset, right? But when we have to pay for it, it's an expense. But why did we add furniture, right? So the same logic applies, because office supplies. Let's say if today you buy, you buy, let's say, a certain stuff. You buy a stationery of 5,000 rupees, or let's say 500 rupees. Will you able to consume that whole stationery in one go? No, you will not. So you have a stationery worth rupees 500 with you. Now you will slowly keep on consuming that. Now as you will keep on consuming, you will keep on deducting it from the value of the stationery and from the capital as well. That's how it actually, that the same impact or the same logic gets applied on the office supply.
Right. Salary and ad expense were deducted at both the end, but why not monthly rent?
The monthly rent was prepaid. If you will see there, we have to we please make it clear in your mind that there is a difference. There's something which is called as expense, and there's something which is called as prepaid expense. When I'm paying an expense, expense is actually getting deducted because it's like immediately I'm getting the benefit out of it, right? So I pay for it. So as I paid for salary, right? So salary is being taken by some other person, and it's moved. The money has moved out of my business, so it has nothing to do with that. I have nothing to do with that now. So that money is gone. But when it comes to the prepaid rent is something which I have paid for the next month in this month only. So you guys, if I hope you guys can recall that matching concept, what we did. That matching concept is that all the expenses, we need to match it with the revenues or with the incomes we have earned. So because your expense is relevant to the next month, you are paid in this month. That's why we have not deducted from capital. Now, what will happen next month? Let's come to it. What will happen next month? Now, your prepaid expense will get converted into expense. That time, and at that moment, you will nullify this prepaid expense, that 500 as a prepaid expense, and then you will deduct it from your capital. So that's how it goes. So it's a step-by-step process which goes on. That's why the salaries and whatever wages we paid, that has been advertisement, that has been deducted because the benefit has been taken. It's been already there. But for the prepaid expenses, we have not got the benefit till now. So we'll deduct it in the next month when it will be due from the capital. I hope I answered.
Right, Prof. The next one is all expenses will go into income statement first, and the final net income or loss will be adjusted against capital. Is it correct?
Perfectly correct. No doubts in that. So all expenses goes to P&L, and then that is being added, but it's not something which is relevant to today's class. That's why now it was not being discussed.
Okay. What are the applications of double entry accounting and which business predominantly uses it?
Double entry accounting is, you can say that all of your accounting is actually based on it. So which businesses actually use it? These days, if you talk about businesses, actually works on softwares, and these all softwares actually they have kind of processed the things in this manner that you just mention what you have done, and the rest of the things will be done. So we need to prepare the accounts first, and then we just need to put a kind of a summarized thing, and the rest of the things would be done. So that's how this happens. But yes, double accounting concept, or this double entry accounting, is still very relevant. It's a part of almost all the businesses that exist.
Fine. Can't we take earned travel income as an asset, but under the head accrued income rather than treating it as debtors?
See, it was not an unearned income. Had it not been unearned, had it been kind of an sorry, I'll come to it again. Uh, it was the income which you have earned but you have not received, right? So anyway, unearned income is something which gets into your liability, right? So unearned income is something which gets into your liability. So this is something which we can say that fine, the amount we can classify it as debtors because we have already earned it. It was not received. That is something which is like there. So you can, if you say that fine, can we make it into the accrued income or something? Yeah, that's a hairline difference, but better to classify it into the debtors because the money is still there to need to be received from the person. That's what.
Okay. How prepaid expenses differ from advertisement expenses? If you treat advertisement expenses as business promotion, will it still impact cash balance or capital balance?
Prepaid expenses and advertisement expenses, a very good question to ask for. If you see, advertisement expenses are also paid in, we at times we pay them in advance, but as we have no information related to that, we cannot do anything into this particular question. Any expenses what we incur, that has to be deducted from the capital, that we are very sure of. But what happens in case of, as I've already told, in case of prepaid expenses, it is something which is the benefit has not been accrued till now. The benefit will come up in the next coming period and then we will adjust it.
Okay. What is the journal entry for asset bought in by owner on credit? As capital also credit and creditor is also credit.
Asset bought by an owner on credit is something which has nothing to do with the business. So if an owner has bought assets on credit for his, that's where we need to classify, it has been bought for the business use or for his own use. He has bought it for his own use. Business has nothing to do with that because it's the separate entity what we talk about always. Right? Business and businessmen are two separate entities. But when we say that it has been bought for business, then we can have an entry where we say that asset account needs to be debited, and from whomsoever person we have bought or the organization we have bought, that can be credited. That is how we can do it.
Fine. When to deduct from cash and capital?
When to deduct from cash and capital. It's like whenever you have an expense being incurred, that needs to be deducted from the cash and capital.
Okay. Do we need to mention miscellaneous in balance sheet?
Miscellaneous, it is with it doesn't happen these days, but it was a practice we used to follow earlier. So these days we don't go for go with anything which is called as miscellaneous. But if you have certain things which are which are supposed to be shown like this, you can do it. There's no rules and nothing like that. Because we need to, the basic objective, we need to understand that the basic objective of accounting is to show the true and fair picture. So if you can make any changes which can make it more better, we are most welcome. You are always welcome with that.
Right, sir. Which is better, accounting equations or balance sheet?
Great question. But see, they both solve a different purpose. Accounting equation, as I told you, accounting equation is something which we learn for our understanding, which is the concept which we need to know. But yes, balance sheet is something which is more beneficial and more useful. And people normally who has not very this accounting and studied accounting will not come to know the accounting equation as well, because people know balance sheet only, so they will talk, they discuss the balance sheet.
Okay.
So just a second. So the balance sheet is more prevalent and more important than the accounting equation.
Right. Difference between representative personal account and outstanding account?
Representative is, we can say, it's like we are mixing the two things. When we talked about representative personal accounts, if we can go back, it was related to the particular category only, right? Representative personal account actually was denoting prepaid expenses and outstanding expenses. And those prepaid expenses and outstanding expenses were representing somebody. See, the point is, when I have an outstanding expense, let's say I had a salary which I was supposed to pay, 10,000 bucks. I didn't pay it. Now that 10,000 is an outstanding expense for me. I'm very clear with that. Yes, it's an outstanding expense for me. But where should I put it? Which category does it goes out to? So I have a salary which needs to be paid to a certain person, a certain individual, or or a certain we can say entity. That's where the representative personal accounts comes in, and that's why the outstanding, prepaid, all they fall into the category of representative personal accounts. So they are not different. They are one and the same.
Okay. The next one is how prepaid expenses is in personal account, though it is an expense.
The same explanation which I just said. That prepaid expenses, yes, it's not a personal account. Yes, because though it's an expense, but again, it is representing someone. The prepaid expense has been paid to someone. That's why it's a personal account. I know it's difficult, but please try to understand and pay attention that the categories that we just discussed, that was representative personal account. So yes, it's an expense, prepaid expense, but again, it has been done to someone. That's why it's a personal account.
Okay. Please explain why debit what comes in, credit what goes out. What is the actual reason behind it?
When we talk about this particular concept, debit what comes in, credit what goes out, the actual concept is that the business, see, this actually applies onto the real accounts. The real account says debit what comes in, credit what goes out. So when we say that what comes in, so whatever assets are coming in, I'm adding them into my balance of assets what I have. And whatever assets are moving out, I need to deduct them from the balance of assets what I have. Let's say I started this month with the furniture of worth rupees 500,000, right? And from in that 500,000, I added more furniture of, let's say, 200,000. So now its total becomes 500 plus 200, that is 700,000. So debit, I mean, it's the real account. So debit what comes in, we can say credit what goes out. So what comes in actually debited and we added, and what moved out. Let's say we sold a furniture worth rupees 1 lakh. So now it is left to 6 lakh. The basic idea is to give you the real scenario, that what is the current position or the net balance right now we have of a certain thing. That is
Right.
what the real is.
Yeah. Will both the method, that is traditional and modern approach, gives the same result?
Yes, it does. There is no doubt in that. It's up to the individual which approach does he follows and what he finds fit. He fits himself with.
Okay. What is revenue account? Difference between revenue account and capital account?
Revenue, when we talk about revenue in accounting terms, it is considered as sales. So whenever we are selling something, that is considered as revenue. Capital is the term which we use for the money which is invested into the business by the owners. So that money which is invested into the business, we call it capital. So capital is a liability. So in that way, the capital and revenue are two different. Revenue is sales, capital is liability. I mean, capital is the money which is invested into the business. So they two are two different things broadly apart.
Right. Normally, we get a transaction in mobile. Message appears in mobile as your account is credited when salary is received with some amount. So here it is credit and not debit. How to understand this transaction?
See, it is because the transaction which the message which you're getting it from the bank, right? And for the bank, your amount is a liability. Your account is a liability. You keep your money in bank, but for the bank, consider it from the bank's perspective, not from your own perspective. So for bank, your money is a liability, right? Because they owe that money to you now. You have deposited 5 lakh rupees in the bank. A bank is supposed to give you 5 lakh rupees whenever you need it. So that's the point. So banks, when you get this message, that actually comes from the bank side. So for bank, your account has been credited. Yes, it has been credited because from them their liability has increased. Similarly, we can show it. We can understand that when we withdraw money, we get a message that your account has been debited. So when we say debited, so it's not from our side; it's from the bank side. Bank has reduced your liability. Your asset from this much of balance, it has been reduced. So if you had, let's say, 90,000 rupees and you took out 20, now the bank has only liability of 70,000 for you. That's why we get a message of credited and debited.
Okay. As we come towards the end, few more questions, Prof. Difference between tangible and intangible assets.
Great. Tangible assets, we can say that tangible assets are actually those assets which can be, kind of have a physical existence. Or in other words, if you look into the other way around, we can say, that fine, they represent their worth. So if I have a machine of, let's say, 5 lakh rupees, I can see, yes, I have a machine of 5 lakh rupees, it's there, right? But when it comes to the intangible assets, there is a term which is called as goodwill. Now, goodwill has a lot of value, but does it have a physical existence? No, it doesn't have a physical existence. Similarly, my trademarks, my patents have a hell lot of value, but does it have that physical appearance in front of me? No, it doesn't have. That's the problem. So the point is that tangible assets are all those assets which can be touched and which have a physical existence which appear in front of you. But if you talk about intangible assets, they don't have a physical existence, right? Patent is just a right you have on a paper, but it has a unbelievable value. So that's where we call them into intangible. So more or less, we can say your intellectual, properties, they fall into the intangible as well with goodwill.
Okay. What do you mean by past journal entries in the journal?
That will be that's the next step immediately after this. What we'll learn in next class, we
Okay.
have just we are on the verge of it, but we'll do it in the next class where we will actually put the amount in front of these transactions. That how it is being done. That it will be journal entries. So we'll do it.
Right. What is patent account?
Patent. It's PATENT.
Yeah.
Patent account is the account which you have for your patent. So that is what we can call as patent account. So it depends, in which context we are using this term. So that clarity needs to be there.
Okay.
So I can have a certain patent and I can find that I can say fine I can relate that also with my account, and I can have a separate account also which I can say this is my patent account. So all the context needs to be clear into this.
Right. Why goodwill, prepaid, rent account, interest assumed account are all called assets?
Goodwill, prepaid rent, and all these are called assets because if you look onto the definition of assets, the definition of assets says that anything which will give you a benefit in future, right? Anything which will provide you a benefit in future or which will help you in growing up your business or making it worth of certain value, that can be called as assets. So if you see goodwill contributes into your business directly or indirectly, right? Prepaid expenses that has because the money is still with us. We have not received the value of that, right? So that's why prepaid expenses is considered as an asset. The amount,
Right.
the benefit will come later on, right? But we have already paid the money, so that benefit is due. So if that benefit is due, you can say that fine, this is my asset because it will give me the benefit in coming years. That's why
Okay.
we call them.
Yeah. How acquisition of asset is considered as a transaction?
Acquisition of asset is considered as a transaction because we pay money for it. So that's a kind of a transaction happens where so your money goes out, your asset comes in. So asset and money, so money changes for an asset. That's why we call it a transaction, and it impacts our business and business flow.
Okay. Um, when we took the credit from a person and while repaying it back partially or fully, why it won't impact or change the capital?
It will not impact the capital because you already have that person as a creditor. You already have that person as a liability. So whom you have to pay. So capital is something which gets impacted by the profits and losses or incomes and gains what we have. But if you have, we can say you are paying a certain creditor, the money goes out and the creditor gets reduced. So the liability gets adjusted. It has no impact on capital.
Okay. What are fictitious assets?
Fictitious assets are basically those assets which don't have, the definition says that actually they were not supposed to be an asset, but as they have no other, appropriate place, so we actually put them into the balance sheet as fictitious assets. So there are
Okay.
terms related to it like deferred revenue expenditures and all those things. They comes into it, but ICI is working on it and trying to get over with this particular concept.
Fine. And the last question, Prof. When we say income account, expense account, does it mean banking account or the name of the statement of the particular transaction?
When we say income account and expenses account, we are actually relating it with that particular transaction. So is it like income is whatever transaction is happening, is that an expense or is that an income? So if I'm doing sales, let's say if I'm doing sales, so sales is my generating revenue. So revenue is my income or my expense. Similarly, when I'm paying salary, so salary is my expense or an income. So we actually income and expense we related with that particular transaction, not with any other thing.
Right. So with this, we come to the end, Prof. Thank you for the very informative and illustrative way of explaining things. Once again, I request you to please share that Excel sheet so that which I can again share it with all the participants for the better understanding, and then maybe they can come with more clarity or doubts or clarification during discussion board meeting. Thank you, Prof. Once again, and with your kind permission and information to learners, we'll get this session to the end now, and we'll connect again at 3 p.m. for the post-noon session. Thank you. Thank you, Prof.
Thank you, sir. Thanks a lot. Thank you, all of you.
Yeah.